Guys, it has been no secret that this year, the Magnificent Seven, as my good friend Jim Cramer has called them, have just been tearing up the market. They're up so much this year. Here's a chart that shows it. Just these 7 companies, Meta, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, up 53% through June 1st. Spoiler alert, it's June 19th right now, and they're up even more. The S&P 500 overall is 11%. All the other 493 companies are even. This market's been driven by these 7 companies. So, of course, people have bought back into this. Oh, see, Paul, you're right. It's a new bull market. We're all done here. Onward to new highs. Could be the case. I don't know what the future holds. However, my job as a value investor is to assess that future and say, based on today and based on what's happening for the future, what does that mean for investments? And of course, I got to be cautious. So it got me thinking this weekend, how can I compare this to the past? So I decided to go back to 2000, the last really, really high bubble we had. In fact, a lot of people got to realize this recent bubble is actually worse than back then. My stock market to GDP indicator hit 110%, which was higher than it hit back in 2000. And it's currently sitting at 78% higher than the historical average. So what does this mean for investments? Well, let's look up the previous, back in 2000, I looked up the top 10 companies, all right? 99, 2000, Microsoft was $578 billion market cap. Today, they're $2.5 trillion. All right, they've gone up 5 times. Sounds like a lot. Guess what, guys? That's only a 6.5% return per year. That's how overpriced that is. GE was $505 billion. Today, it's $115. Cisco was $360 billion. Today, it's $212. Walmart was $303. Now it's $418. Guys, it only went up not even 40% in a matter of 23 years. ExxonMobil, 280 to 425. Intel, 270 billion down to 152. Lucent Technologies, 218 billion, and in 2003, it was 15.6. 3 years later, it had fallen 90% almost. Over 90%, sorry. IBM was a $181 billion company. Today, it's 128. Citibank was 195 billion. Now it's 94 billion. And guys, AOL, that was the big company back there. It was 158 billion, and it sold for 4.4 billion back in 2015. Total of all these 10, $3 trillion. And the S&P market cap back then was 12.7 trillion. It made up 24%. So before I go into what it is today, I want you guys to remember, these are the top 10 stocks. And how many of them are higher today than they were back then? 1, 2, 3. Microsoft, Walmart, ExxonMobil. Microsoft went from 578 billion to 2.5 trillion in 23 years. That's 6.5%. Walmart, not including dividends, to the 23rd for 23 years. It's 1.4% return. And you might sit there and say, well, that was different back then. It wasn't, guys. That was the start of the internet age. That was the start of a new world. And it's still, and how much bigger is the internet today than it was back then? You might sit there and say, well, Paul, not all these companies are tech companies. Well, that's true. I give you that. But a lot of these were driven by all this tech mania. But this was tech. This was tech. In fact, Cisco was the one that everybody said was going to be the first $1 trillion company. It hit a high of 500 billion. This was tech. This was tech. This was tech. And this was tech. That's what? 6 companies out of 10. And it was 24% of the GDP, of the stock market value. Now, a lot of times people have to realize that back then, the reason for the big crash was people said so few overpriced companies took up such a big chunk of the entire market. Well, guys, let's go to the next page here. This is what it is today. Apple, 2.9 trillion. Microsoft, 2.5 trillion. Google, 1.6 trillion. Amazon, 1.3. NVIDIA, 1 trillion. Tesla, 825 billion. Berkshire Hathaway, 735. Meta, 720. Visa, 480. United Health, 426. Again, this is the only one that's still on the list from 23 years ago to today. So I want you guys to remember that. Total, 12.5 trillion. That's the entire market cap we had, S&P market cap back in 2000. But the entire S&P 500 market cap today is 34.4. It eats up 36% of the S&P's entire market value. Now, I want to take it one step further for you guys to show you guys how big of a difference that is. This is going back to the Magnificent Seven. So I'm going from the top 10 to the top 7. Going back to 2013, this is how much of the Magnificent Seven market cap as a percentage of S&P. It was as low as 7%, as high as 29%, as low as 20 last year, back up to 28%. Guys, these are big differences. If this doesn't scream euphoria, I don't know what does. This is maniacal behavior about a couple of individual companies. NVIDIA sells for 41 times revenue, not profit, revenue. And profit's always smaller than revenue. The assumptions about the future are grandiose. Again, I don't know what the future is going to hold. However, my guess is that over the next 20 years, the top 10 will change significantly, and a lot of the ones that are there today probably won't be worth more than they are today 20 years from now. That might sound ridiculous. It is ridiculous, but history has always shown that. Over 20-year periods, the top companies in that first year versus the next first year 20 are very, very different. Technology changes. You're going to be remembering this as the age of AI. And 20 years from now, 25 years from now, younger people are going to be telling you, yeah, that was AI. That was totally different than this new thing we have now. Just like the internet was the new thing. And I talked about, well, what about computers? No, computers are totally different. This is the internet. Fast forward. No, you don't get it. It's electric vehicles. You don't understand. 2 years later. No, you don't get it. This is AI. This is going to change the world. Guess what? I believe that computers change the world, internet changed the world, electric vehicles change the world, and AI will change the world. They can all change the world, but they can all be bad investments as well if you don't pay the right price. And that's the big difference in our channel versus everybody else. We don't chase hype. We believe that every investment is the present value of all future cash flow. And we believe when you buy a stock, you're buying a piece of a business. And if you don't pay the right price, you can end up losing on a very, very, very great business. Microsoft has proven that they're a great business. Look at them from 2000 to today. Let's pull up the information. In 2000, they did revenues of $23 billion. Today, their revenues are 207. What is that? 207 divided by 23 to the 23rd power. That's 10% growth per year. But what happened to their stock price? Only went up 6.5%. Okay, let's look at their profit then. Their profit this year, in the last 12 months, was $70 billion. And in 2000, it was $9 billion. So 70 divided by 9 to the power of 1 divided by 23, 9.3%. They increased their profit by 9.3% per year, but their stock only went up 6.5% per year. Now, they did pay a dividend, added 1% in there, which I don't think it was 1% over the last 23 years. But even adding 1%, you're at 7.5%. It still trailed. Why? Because if you overpay for a good business, it will suck for you. Now, you might sit there and say, yeah, Paul, but if I had not done that, I'd missed out on Microsoft. Yeah, you'd have missed out on Microsoft, but look at the other 9 companies that aren't on the list today and how much they've fallen. That's the big thing. I put it this way. If you think that the story of the company matters more than the fundamentals, I'm not the channel for you. We are not the channel for you. Unsubscribe, delete us, block us, because we're not the channel for you. But if you believe that what I'm saying makes sense to you, I'm not saying you have to agree with every assessment I make, but if it makes sense to you that when you buy an investment, you're buying a stream of cash flow. And that cash flow is going to depend, the return is going to depend on the price you pay today for that cash flow. Let me give you an example. If I told you for the next 5 years, I was going to give you $1, then $2, then $3, then $4, then $5, what would you pay for that today? It's a total of $15. If you paid me $15 for it, you're not going to make any money. In fact, you'll lose some because this assumes I'm able to pay you. This assumes a lot of things, including why would I wait 5 years to get my money back? You pay $1 for it, though, you're probably going to do pretty well. That's all I'm saying. What are you paying today for that stream of cash flow? NVIDIA's cash flow is probably going to increase tremendously over the next 20 years. But if you overpay for it, you're not going to see the benefits of that. Intel makes more money today than it did 23 years ago. Well, I should say before their restructuring, and yet the stock never saw its 2000 price. Cisco makes more money today than it did 20 years ago. Walmart makes more money today than it did 20 years ago, and the stock's only up 1.5%. Why is that? This is what I want to repeat to everybody. These Magnificent Seven and the top 10 companies are usually that big because of some sort of euphoria and hype. And when I look at how much the market's up in the last 6 months from no fundamental reasons, it makes me go, okay, this is interesting. That's all I'm trying to do here. So if this makes sense to you guys and you like what I'm saying, I'm asking you to do 2 things. First off, subscribe to the channel. And secondly, if you like my comments on this, follow me on Twitter, @PaulGabriel. I'm very active on there. I talk a lot about my investment ideas in terms of what I think about things, the economy, et cetera, and I engage with a lot of people. So guys, check it out. Thank you very much for your time.